Hello students, welcome to MBA in Hospital and Healthcare Management. I am Dr. Ravikumar Tati. I am going to talk about on International Financial Reporting Standards. This topic is from Financial Accounting of your first semester of your MBA program. International Financial Reporting Standards. This is part of your accounting discipline, and every accountant is expected to understand what these standards mean. Let us say that you have two companies, one in Britain and another one in Japan, and these two companies are on different in different locations, that is Japan and Britain, and the respective regulations are different. The currency in Britain is in pound, while the currency in Japan is yen. So, in yens the financial statements are prepared, and prepared in Japan, and in pounds the financial statements are prepared in Britain. Both the companies are making profits, and you are very happy. But when you want to compare which company is doing better, that comparability when you talk about that becomes difficult, because one country's currency is in yen and another country's currency is in pounds. So, there is a way difference between yen and pound. So, therefore, comparability is the problem. So, therefore, international financial reporting standards has become inevitable. Till 2001, there were accounting standards across the globe, international accounting standards. The international accounting standards were set up by the International Accounting Standards Committee, and the International Accounting Standards Committee then resulted in International Accounting Standards Board, and all of them derived from mostly the US GAAP, the United States generally accepted accounting principles. Now, when you look at India, India has Accounting Standards Board. This Accounting Standards Board is under the ICAI, the Institute of Chartered Accountants of India. The Institute of Chartered Accountants of India is set up with the enactment in the Parliament by the Government of India, which means the Accounting Standards Board, which is part of the ICAI, is under the Government of India. Though it is not part of the government, but it is a separate professional body set up for professional excellence in the field of accountancy. Now, as we all know, accounting is the language of business, and if this language is not understood uniformly, equally, by all stakeholders across the globe, then there is no meaning. Let us say I am an Indian and I speak Hindi. Hindi is my national language, and this Hindi may not be understood in Germany, this Hindi may not be understood in Japan, or may not be understood in Britain. But if it is presented, or if I speak the same lecture in English, it is understood in most of the nations. Not all countries, I say, speak English, but majority of the nations follow English. They can understand English. Same thing is with the accounting standards. You have British accounting standards, you have United States accounting standards, you have Asian accounting standards, and Chinese and Japan and Malaysia. Every country has accounting standards of their own, and India has a solid set of accounting standards with thanks to the Accounting Standards Board of ICAI. But all of them are not following the same principle. When the globe is shrinking day by day and year by year, and it has become almost the village we call global village, the business is transmitted and the transactions are crossing the borders. So, when this is the scenario or the situation, you have to introduce such a language where every nation, wherever these companies are set up, wherever this business is flourishing, you had to introduce such a language that every company, every stakeholder to that company can understand. So therefore, accounting standards are to be understood uniformly by all the stakeholders across the globe. This is the idea of setting up of international financial reporting standards committee, resulting in international financial reporting standards board. So this board is responsible for setting up of the international international financial reporting standards, the reporting standards, IFRS. Now, though these standards are accepted by almost 144 nations, and some countries make it mandatory that you must comply with these accounting standards. But some countries are saying you can follow these accounting standards. While some countries make it mandatory, some countries are making it optional to the company. Whatever be it, it is about 144 countries are complying with these international financial reporting standards. But the US prefers to retain their own standards, that is US GAAP, United States generally accepted accounting principles. Now, what's the difference between the US GAAP and the International Financial Reporting Standards, IFRS? The US GAAP is rule based. Okay, there are rules, set of rules and regulations, and you have to just follow that rule. Now, let's say for valuation of inventory, LIFO is followed. Let's say if that is a rule, you have to simply follow that rule. For calculation of depreciation, you must follow straight line method of depreciation. If that is the rule, then you have to comply with that rule. It's a rule based standard. Generally accepted accounting principles are rule based standards, and most of the accounting standards across the globe also, countries or the nations which are not complying with IFRS may be following their own standards, and most of them are rule based accounting standards. They are not principle based. Now we are coming to principle based. There are principles. Okay, the IFRS is based on the principles. Okay, now what are those principles? There are 5 sets of principles in accounting. Now, number 1 is basic principles, or the premises on which these IFRS standards are hinging on. The accrual concept is number 1. Accrual concept means whether the income is received or not, whether the expenditure is incurred or not. Come again. Yeah. The accrual basis says whether the expenditure is received or not. The expenditure is the accrual basis concept says, once again, the accrual basis concept says whether income is earned or not, whether expenditure is incurred or not, they have to be accounted for. Whether the income is earned or not, whether the expenditure is earned or not, they have to be accounted for. That is accrual basis of concept. Now, in the accrual basis, there are certain debtors presented in the financial statements. There are some creditors, and because of the huge amount of debtors, the balance sheet may be showing high amount of assets, and because of the debtors, your sales volume, because of the credit sales, there may be huge amount of debtors. because of the credit sales, though you have not received any cash, your sales volume may show very high. Your credit sales may be 80%, cash sales may be 20%, but because the sale transaction completed even without payment, and you account for it for that accounting period or the financial year. And when you account, all that profit that you see may not be cash. Okay, this is the accrual concept. This is one principle that IFRS stands on, or hinges on. And next one is going concern concept. Going concern concept. We all know, as we are learning the accounting principles, we learned about going concern concept. When you are setting up of an organization, when you are an entrepreneur, have an idea and would like to translate that into business, commercialize that idea, you set up a business. Therefore, you are called an entrepreneur. And when you are an entrepreneur, you don't set up the business just to run for an year or two, then close it and take that money or profit. This is not the intention of any entrepreneur. Anybody who is coming to set up the business, they come to set up the business for a purpose that this business continues forever and ever into perpetuity. It goes on, and one generation after another generation, it goes on from generation to generation. If you take the example of Jamshedji Tata and look at his son, after that his son JRD, and after that his son Ratan, and after that it goes on. It may be sons or daughters, or it may be some other successor, okay, in the joint stock structure of business. It goes on forever and ever. Who started L&T? Some foreigners started L&T, but today that L&T company continues to exist, even run by the Indians. So when you set up the business, you set up the business with a purpose that it should go forever and ever. Now this is another principle. Which is the main core principle of the IFRS. The third principle I would like to touch upon is consistency. Consistency is one more important principle on which the IFRS hinges on. Consistency, when you are following a certain accounting policy in this accounting year, you have to continue the same accounting policy the next year, the next year, the next year. Let us say you have in your group of companies, you have branches in 30 locations across the globe. Whatever policy you are following to report a particular item, let us say again, for example, if you are taking depreciation, for reporting depreciation, for calculation of depreciation and reporting the same, you are using only straight line method. Now you cannot use diminishing balance method or weighted average method in different countries. In China, you are using different weighted average method. In Russia, you are using diminishing balancing method, and it is not consistent with the home country's policies. In home country, in India, you are following straight line method. Across all your branches, you have to follow the same straight line method of depreciation. And that's where you see consistency. Now you may ask me why this has to be followed. For those countries' accountants, that method may be more convenient, or they may be used to that kind of method or policy. But I say, for the comparison purpose, or for the analysis and interpretation purpose, which country's company is doing well, which country's branch of our company, group of companies, is doing well or not doing well or struggling to reach the break-even point. So you are trying to make an analysis. That analysis is not possible when you have when you're not following the consistency, when you're not following the uniformity. Okay, now let's come to the comparability, okay, and the fair value also, okay, fair presentation. True and fair presentation, the SEBI, the Securities Contracts Regulation Act 1956, and it which was applicable for about 4 or 5 decades, then later on resulted in 1990s with the enactment of 1992 SEBI Act, Securities Exchange Board of India Act. This SEBI Act came into and said this SEBI, the setup organization, is set up with the purpose of protecting the interest of the shareholder, okay, to promote the capital markets, to promote the business, investing business in the country, and to set up the guidelines for the brokers to operate, okay, and other operators and the companies and the stock exchanges. Fine, all these are with a simple and a single point, that is protect the interests of the investors. Who are the investors? Investors are the people who have brought money and investing in your company. It is not because they are rich people. Part of their incomes they are setting aside as savings. Sometimes they themselves may be investing in the company, sometimes they may be investing in a bank or in a mutual fund company or in a saving policy like LIC or life insurance, private life insurance or public life insurance companies. When they are setting aside like that, those funds are channeled through these mutual funds and life insurance corporations and even banks, commercial banks. They channel that to invest in the shares, the stocks. Now, ultimately, when you look at the money that is flowing in the stock market, whose money is that? That is not only rich people's money, it is the sacrifice of the middle class or the upper middle class. Even sometimes the lower class people also may be intending to set aside some money in the mutual fund for meeting their future family needs. Future family needs like for their children education and children marriages and building a home and things like that. So when they are setting aside part of their income and that money is flowing in the form of investment, that has to be protected. And when that has to be protected, strict rules and regulations have to be formulated. Strict rules and regulations to frame with, there is an organization set up, that is SEBI. SEBI requires true and fair presentation of the accounting data. Accounting is the language of business. If this language is not legible, let us say if your handwriting is not clear to understand what is the use of your writing. You may be a very good scholar, you may be a professor, you may be a doctor or an excellent oratory skills you may be possessing, but when you write and what you write is not understood by others, that writing is of no value, it carries no value. It should be legible, it should be understandable, need not be beautiful, need not be impressive, but it should be understandable. So therefore, the accounting information that is presented to the stakeholders, it should be presented in such a way that the person who has never been to a college, the person who has never been to a commerce graduation degree should be able to understand. An engineer should be able to understand, a doctor should be able to understand, and even a farmer who is setting up aside the money into saving funds also should be able to understand with a minimal education. So what is that? True and fair presentation of the accounting data. As you are supposed to write legibly, you are supposed to present the accounting information in an understandable way to all the stakeholders. So this is another premise on which the IFRS is hinges. Okay, then these are the basic principles on which the IFRS is standing. Now, IFRS is principle based, not the rule based. When it is rule based, like in the case of GAAP or like in the Indian accounting standards, some of the Indian accounting standards, when it is rule based, even when it is costing the shareholders, okay, a huge loss, even it's causing a huge loss to the exchequer, even if it is damaging the financial system, because the rule says that and we are simply complying that rule, and that may not be working. So when it is a principle based, and principle allows circumstantial judgment. So when it is principle based, the accounting standards are when accounting standards are principle based, the principle allows the circumstantial judgment. For example, when materiality is the concept, okay, it's a principle, accounting principle. Materiality, there's an eraser. An eraser may be costing 2 rupees and a pencil of 10 rupees. Now, when you look at 2 rupees, this is also money. Okay, when you are spending, remember you are spending the investor's money. This also has to be accounted for. So what you will be doing, you will be taking pencil, pen, eraser, sharpener, or the A4 sheet, all that you are using for the office purpose. You are not misusing. You are using it. When you are using this, you are supposed to account for. When you are accounting, you account with just one word, that is stationery. It's a principle based. Okay, stationery is one word wherein you dump all these items and then record in the books of accounts. An Alpine board, you cannot, if you go on recording all those minute things, the memory may not be sufficient in your computer, the papers may not be, A4 sheet bundles may not be sufficient in your office, and there's no space to keep. So you have to use your discretion of converting that to the near. Sometimes you may have the doubt also, after the zero, 90 lakhs 22,498 point, after zero, after dot or after point, how many digits should to be considered for multiplication? Okay, that also is based on the circumstantial judgment, based on the size of your business. For a huge company, those dots may be insignificant, okay, but for a small company it may be significant. Fine. So these are the accounting standards, these are the premises. How these accounting standards impact? I will take few things, okay, few examples, few cases, and then close our discussion for today. Let us say IFRS 16, one example I will take. IFRS 16, it deals with leases, okay, and it deals with leases and lease companies, lease business is there, okay, hire purchase and leasing. When there is a hospital and the hospital requires 100 crores worth equipment for the radiology department, and this is essential for a multi-speciality hospital of, let us say, 500 bedded hospital. But the 500 bedded hospital may not be able to afford for it. Then they may have the contract with GE, or they may be having contract with any supplier of this product or this machine or equipment in the radiology department or in the oncology department. Okay, they may have the contract wherein they will supply the machinery. Most of the machinery that you see in the hospitals, they are leased assets. They are leased properties. Now, when they are assets in your premises, you are not the owner of the asset, but you are in the possession of that asset. You had to pay the lease. Now, when you are paying the lease, how to treat the depreciation on this asset? It depends on your understanding with that company. There is a rent, there's a lease which is like a rent for that asset which you are using per month or per annum, and that asset is not yours. Okay, now should you treat the lease expense or the lease rent, okay, as expense in your income statement or profit and loss account, or the depreciation calculated on that asset? Okay, so this has to be understood. This problem has to be understood. For the company, it is a lease which is expense, not the depreciation. Because he is not the owner of that asset, the owner takes care of the depreciation, but for you, you have to account. For you, the expense is the amount of rent you are paying for this leased property. Okay. Now, this is what. So, likewise, there is something called translation exposure. Transaction exposure, translation exposure. When you look at the translation exposure, you have the company in different countries. All those countries' currencies are different. And your company's home country is India. And how do you want to know whether your company is doing excellent or good or okay or very bad or bad? When you take all those currencies into Indian rupee terms only, what is that? You are trying to translate rubles into rupees. You are trying to translate the British pounds into rupees, US dollars into rupees, Singapore dollars into rupees, Australian dollars into rupees, Germany marks into rupees, Japanese yen into rupees. All those countries' currencies are translated into Indian rupees so that you will come to know the exact amount of profit from all 10 branches located in 10 different countries. And then you will come to know this is our profit. Let us say, while translating, the currency exchange rates fluctuate. Because of that fluctuation, there may be a loss, or that's called in finance as risk. There may be a translation risk. So, therefore, international financial reporting standards are of vital importance, and I have just picked up couple of examples. As you read your material and surf through the sources, thousands of sources available on internet, you can get. Thank you very much for your listening.